When you buy a brand new computer, the very first thing you actually interact with isn't the hardware at all.
Right, you're not messing with the chips.
Exactly. You don't touch the silicon or, like, the motherboard. You interact with the operating system.
Yeah.
It's that invisible foundational layer running quietly in the background that dictates absolutely everything the machine can do.
Yeah, and what it can't do, too.
Right. And if that operating system is buggy or, bloated, I don't care how fast your processor is, everything you try to build on top of it is just going to crash.
Because the friction is too high, the underlying architecture has to handle the complexity so the user doesn't even notice it.
Exactly. But if it's seamless, if it's perfectly optimized, it completely unlocks the potential of every single application. You basically stop fighting the computer and just start creating.
Which is the dream, right?
Yeah. Well, take that exact idea, but I want you to zoom out. Way, way out. Instead of the laptop, imagine we are talking about the operating system for an entire country's economy.
And not just any country.
Right. A nation of over 1.4 billion people. Today, for you, the listener, we are doing a deep dive into a really fascinating blueprint. It's laid out in a series of articles from Democracy for Nepal.
Which is a fantastic source for this.
It really is. They are mapping out how India is rapidly expanding its digital public infrastructure. They call it DPI. But here is the real hook. This isn't just about India upgrading its own internal tech.
No, the ambitions are much bigger than that.
Way bigger. This is about them building a new national operating system, so incredibly efficient that they are positioning themselves to export it.
Yeah.
They are essentially preparing to rewrite the fundamental economic rules for the entire global south.
Which is why this matters directly to you, honestly, regardless of where you live or, what currency is sitting in your wallet right now.
Yeah, exactly.
We are not just talking about an IT upgrade here. We are looking at this profound collision of digital infrastructure, immense political capital, and, frankly, a massive shift in geopolitical strategy.
It's all coming together once.
Right. And if the blueprint we are examining today actually succeeds, we are watching the architecture being laid down for a world that simply no longer relies on a single dominant global currency.
Like the US dollar.
Exactly. A world that doesn't need the dollar to conduct its daily business.
And the mechanism they are using to do this is something the research calls the digital triad.
3 pillars.
Right. It's this theoretical three-pronged combination: universal digital identity, instant zero-cost payments, and digitally secured blockchain-backed land records.
It's a massive undertaking.
It is. The core argument here is that if a nation can seamlessly integrate those 3 pillars, they remove so much societal friction that they just unlock a level of wealth creation we've never seen before.
Because if you think about what actually holds a developing economy back, it's friction.
So much friction.
Right. It's the friction of just proving who you are to a bank.
Yeah.
Or the friction of trying to move money across town without getting robbed, or, paying extortionate fees.
Or proving you own your own house.
Exactly. The friction of proving that you actually own the land you live on. When you digitize and guarantee those 3 things at a population scale, you fundamentally alter the economic trajectory of the entire nation.
So to really grasp where this digital triad is heading, we need to look at the base code that's already running, right?
Yeah, the stuff that's already built.
We have to understand the 2 pillars India has already established, and crucially, the specific political climate that the research argues is fueling this massive expansion right now.
The political context here is paramount. You can't ignore it. The authors of the Democracy for Nepal pieces frame this entire technological push within the context of the current ruling leadership.
The BJP.
Right. Moving toward a potential 2/3 majority in mid-2026. Now, looking at this impartially, as the sources do, this level of political consolidation provides an enormous amount of what we call political capital.
Meaning they basically have the sheer legislative muscle to push through structural reforms that have been debated for decades. Things that, like, a fractured coalition government could just never pass.
Never. The analysis points specifically to proposed legal unifications. Things like one nation, one vote.
Which would align local and national election cycles, right? To streamline governance?
Yes, exactly. And also the Uniform Civil Code, which aims to standardize personal laws across different communities.
Okay, so how does that tie into the tech?
Well, the thesis of the source material is that these massive unifying legal frameworks create the domestic social cohesion and administrative stability you need. You need that solid base to take these digital ambitions and scale them globally. The argument is simple. You need an incredibly strong, unified foundation at home before you can project economic and technological power outward.
That makes a lot of sense.
Hmm.
So with that political engine roaring in the background, let's look at the actual tech. Pillar one of this digital operating system is Aadhaar.
The identity layer.
Right, the digital identity layer. And the sheer scale of this is almost hard to comprehend. I mean, they launched it back in 2009,
Which is ancient history in tech terms.
literally a lifetime ago.
Yeah.
But now it covers between 1.3 and 1.4 billion residents.
It's staggering.
It really is. It pairs basic demographic data with biometrics. So we're talking fingerprints, iris scans, facial recognition.
But we have to look past just the technology itself. We need to examine the structural economic shift it created.
It actually impacts.
Let's look at it practically. Before Aadhaar, let's say a commercial bank wanted to open a savings account for a rural farmer. The bank has to perform what's called KYC.
Know your customer.
Exactly, know your customer, to comply with anti-money laundering laws. Historically, in India, this was a manual, paper-heavy nightmare.
I can only imagine.
You needed physical photocopies of utility bills, wet signatures, manual verification by a human. The research notes that this identity verification process used to cost the bank anywhere from $10 to $20 per transaction.
Wait, let's pause on that math for a second because that's
Mm.
huge. If I'm a bank and my baseline operational cost just to legally register you as a customer is $20, I simply cannot afford to do business with you if you only want to deposit like $5.
Not a chance.
The profit margin isn't just zero, it's profoundly negative.
Which means you have effectively priced the poorest populations out of the formal financial system by default.
Wow.
The friction is just too expensive. But then the government introduced Aadhaar's eKYC. This is electronic verification where a customer just scans their fingerprint at a local terminal.
And the cost drops.
Plummets. That $20 verification cost just vanished. The sources cite it dropping to roughly 27 cents per transaction.
$20 down to 27 cents.
Yes.
That is an absolute paradigm shift. It completely flips the entire business model of retail banking.
Totally. Suddenly, managing microtransactions and opening micro-savings accounts for hundreds of millions of people isn't a burden. It becomes highly profitable for financial institutions.
And furthermore, this identity layer enables a massive governmental shift, right?
Yeah.
To direct benefit transfers, or DBT.
Oh, absolutely. Because if the identity is biometrically secured and directly linked to a unique individual's bank account, the government can bypass the entire bloated chain of local bureaucrats.
Which drastically cuts down on the leakages, right? And the outright corruption that historically just plagued welfare systems in developing nations.
Precisely. Subsidies, pensions, emergency relief, it all flows instantly from the treasury right to the citizen's pocket.
Okay, so you've solved identity. I can prove who I am instantly and for pennies. That leads us right into Pillar 2, which is UPI, the Unified Payments Interface.
The money layer.
Exactly. If Aadhaar is the identity layer, UPI is the money layer. And the volume described in the sources is just nuts. We were talking about 10 to 11 billion transactions per month.
A billion, with a B.
Yeah, representing anywhere from 70 to 83% of all digital payments in India.
Hundreds of millions of microtransactions every single day. Buying a cup of tea on the street, paying a rickshaw driver, settling a utility bill.
I think the best way to understand how UPI mechanically works is to compare it to the current Western banking system.
That's a good approach.
If I want to send you money right now, and we use different banks, it's a huge hassle. I need your routing number, your account number. We might have to use a third-party app that takes a percentage.
Or wait a few business days for a wire to clear.
Right. There are walled gardens absolutely everywhere. UPI demolishes those walls. It functions like a universal translator for money.
That is a great way to visualize it. The government, specifically the National Payments Corporation of India, built the underlying rails. They created a system where every citizen gets a virtual payment address.
Which basically looks a lot like an email address, right?
Very similar, yeah. And it sits entirely on top of the traditional banking system. So it allows seamless, real-time, zero-cost transfers across any bank, 247.
And the crucial architectural decision here, which the sources highlight, was interoperability.
Yes, that was brilliant.
The state paved the digital highway, but they didn't mandate what kind of cars you have to drive on it. Private companies, whether it's Google Pay, Walmart's PhonePe, or a local startup, they build the user-facing apps.
Exactly. So you have this fierce private market competition for the best user interface. But the underlying transaction network remains a highly regulated, free, public good.
It's honestly brilliant.
Oh.
But the sources don't just stop at identity and payments. They map out this broader ecosystem built on top of these two pillars. Collectively, they refer to it as the India stack.
Right.
And there's a third component to this base layer that I find absolutely wild, the data sharing layer. The research calls this the account aggregator framework, driven by DEPA.
The data empowerment and protection architecture.
Right. Can you break that down?
Sure. To understand DEPA, you have to look at the mechanics of financial consent. Let's say you run a small business and you need a loan to buy new equipment. Traditionally, proving your creditworthiness means physically going to different institutions. You're printing out months of bank statements, tax returns, maybe insurance documents.
So it's a massive stack of paperwork.
Right, and you're handing this massive stack of very vulnerable paper to a loan officer. It takes weeks, and you have zero control over what they do with those photocopies once you leave the office.
Which is terrifying when you think about it.
It really is. The account aggregator framework entirely digitizes and democratizes that process. It is a consent routing mechanism.
So how does that look for the user?
You log into an app and you officially grant a temporary cryptographic token of consent. That token allows your bank to share your transaction history directly with the new lender.
So I just hit approve on my smartphone, and behind the scenes, my bank securely pipes my data to the lender.
Yes.
They underwrite the loan via an algorithm, and I could theoretically have the money in my account in 5 minutes.
In theory, yes. You retain ownership of your data and use it as leverage to access services. And because this architecture is modular, it's being replicated across other sectors.
Oh, right. The sources detail the ONDC, the Open Network for Digital Commerce.
Which aims to break up e-commerce monopolies by connecting local buyers and sellers directly.
And there's also the Ayushman Bharat Digital Mission for porting digital health records between doctors. And DigiLocker, right?
Yeah, DigiLocker is huge. It's a state-run digital vault with hundreds of millions of users holding verified, official documents.
The compounding economic effect of all these systems talking to each other is massive. The sources refer to the JAM Trinity.
Jandan, Aadhaar, and mobile.
Right. Jandan being the basic financial accounts, Aadhaar the identity, and mobile phones. That trinity pulled hundreds of millions of people into the formal economy in just a few short years.
The economic data and the research is clear on this. It shows this digital public infrastructure contributed about 0.9% to India's GDP in 2022.
But they project it to hit, what, somewhere between 2.9 and 4.2% by 2030.
Exactly. When the cost of establishing trust and the cost of moving value both drop to near zero, commerce doesn't just grow. It hyper-accelerates.
Okay, but I think we need to pause here because I have to push back a little on this technocratic utopia.
Fair enough.
We are talking about an incredibly centralized population-scale database. It contains the biometrics, the financial histories, and the physical locations of over 1 billion people.
It's a massive honeypot.
Yeah. And the Democracy for Nepal pieces do highlight the dark side of this. They explicitly mention privacy breaches. They point to the 2023 Digital Personal Data Protection Act, which apparently includes significant carve-outs that exempt the government from certain privacy constraints.
Yes, that is a major concern raised in the text.
And there is a genuinely heartbreaking point raised about the reality of biometric exclusion. I mean, if you are an elderly laborer and decades of manual work have physically worn away your fingerprints.
The scanner won't read them.
Right. The scanner at the ration shop might just reject you. The machine basically says you don't exist, and suddenly you are locked out of basic food subsidies. How does a system this vast reconcile population-scale efficiency with the fundamental rights of the individual?
It is the defining architectural and governance challenge of DPI. The sources don't shy away from this at all. From a cybersecurity perspective, the threat of linkage attacks is severe.
Linkage attacks.
Yeah. If a bad actor can access your Aadhaar number, they might theoretically piece together your health records, your bank details, and your tax history across different, supposedly separate databases.
Because it's all tied to that one central number.
Exactly. And the legislative carve-outs for the state elevate those concerns about unchecked surveillance. But the exclusion errors you mentioned, that is where the theoretical elegance of code collides with messy human reality.
Right. When a line of code or just a dirty scanner lens dictates access to life-saving calories, a technical glitch isn't an IT problem anymore. It's a humanitarian crisis.
Exactly. The analysis concludes that the ultimate viability of this DPI rests entirely on its governance. The technology works, but the institutional safeguards must evolve rapidly alongside it.
They need manual overrides.
Right. Fallback mechanisms for biometric failures, manual overrides, facial recognition alternatives, and strict, transparent audits of government data access.
Frictionless for the 99% cannot mean impassable for the most vulnerable 1%.
A critical point.
So we've explored the first two legs of this digital stool, identity and money. But the sources argue that a two-legged stool falls over.
It does.
To actually unlock generational national wealth, you need collateral. You know, assets that can be leveraged. And this brings us to the most complex part of the blueprint, what the text calls the precarious missing third leg of the digital triad, land records.
This is where we transition out of the pure digital realm of data and back into the physical, muddy, highly contested reality of property rights.
Yeah, real dirt.
In many developing nations, the system of land ownership is disastrous. It's this chaotic blend of colonial-era paper ledgers, customary tribal rights, informal squatting, and just completely unclear boundaries.
And the research emphasizes how this lack of clarity, compounded by local corruption and fraud, essentially traps assets. It creates what economists refer to as dead capital.
Dead capital, yes.
Let me try an analogy to make this concrete for the listener.
Yeah.
Imagine you inherit a massive iron safe, and inside that safe is $1 million in gold bars.
Okay, nice inheritance.
Right. Everyone in your town knows the safe is sitting in your living room. Technically, on paper, you are wealthy. But the lock is broken and you don't have the combination. You literally can't open it.
You're rich, but you're broke.
Exactly. You can't take that safe down to the bank and say, hey, use this gold as collateral to give me a loan so I can start a business. The value is physically there, but economically it is dead. It's trapped. That is what it means to live on a piece of land without a clear, legally verifiable digital title.
That captures the friction perfectly. You possess the asset, but you have absolutely no legal mechanism to leverage its value in the broader economy.
So how do they propose fixing it?
The blueprint proposed in the sources is called Land Aadhaar. The vision is breathtaking in its ambition. They want to digitally map every single plot of land in the country, establish a clear title, and link that specific geographic plot directly to a family or individual using their Aadhaar digital identity.
But the circus are careful to point out that just scanning a bunch of old deeds into a PDF doesn't fix anything.
Oh, no, that would be a disaster.
They pair this with necessary legal reforms, tenancy reforms, market-friendly redistribution, consolidating heavily fragmented farms.
Because if you just digitize a broken, contradictory paper system, congratulations, you've just created a faster digital broken system.
Right.
The legal rights have to be clarified simultaneously with the digital mapping. If a nation can pull this off, the macroeconomic implications are massive.
Because clear, verifiable titles mean financial institutions can confidently lend money against that land.
Exactly. Risk plummets, which means interest rates plummet, opening up formal credit to millions of people who previously had to rely on loan sharks.
And the research makes a great point that this unlocks a massive wave of grassroots entrepreneurship. You aren't just trying to get people factory jobs, you are giving them the collateral to build their own micro-enterprises.
Which drives the bulk of local employment anyway.
Right. But here's the elephant in the room. Trust. How do you create a system of land records that citizens and banks implicitly trust? Especially in areas where, historically, a corrupt local official could literally take a bottle of whiteout to a paper ledger, change a name for a bribe, and steal a family's farm.
Enter the blockchain.
Okay, stop right there.
Yeah.
Whenever anyone says blockchain, I feel like half the audience rolls their eyes and thinks about volatile crypto speculation and, like, digital monkeys.
Sure, the hype has done a lot of damage to the actual tech.
But the sources aren't talking about digital currency here. They are talking about the underlying ledger technology. Let's break down mechanically why blockchain is the specific engineering solution for land registries. The research highlights 4 key features: immutability, transparency, smart contracts, and decentralization.
Let's unpack the mechanics of each because it's important. Immutability is the bedrock. In a traditional database, an administrator with the right password can go in and alter a record. And unless you have deep audit logs, no one even knows.
But on a blockchain?
A blockchain uses cryptographic consensus. Once a land record is entered and validated by the network, it is cryptographically sealed. It cannot be altered, deleted, or tampered with by any single actor, no matter how much political power they have.
Which instantly solves the problem of the corrupt official with the whiteout.
Yes.
Okay, what about transparency?
Transparency means that authorized parties, like a bank evaluating a mortgage application, can view the entire unbroken chain of ownership history in real time.
So they don't have to hire a title researcher to spend 3 weeks digging through dusty municipal archives.
Exactly. They can trace the provenance of the land instantly.
And then we get to smart contracts.
Hmm.
I want to make sure I understand how this actually executes. A smart contract isn't a legal document written by a lawyer. It's a piece of self-executing code, right?
Precisely. Let's say you are buying my plot of land. We use a smart contract on the blockchain. The code is incredibly simple. It basically says, if buyer transfers X amount of digital currency to seller, then instantly transfer digital title Y to buyer's name.
Okay.
The moment your payment clears the UPI or CBDC network, the smart contract triggers automatically. The title transfers in seconds.
So we completely bypass the lawyers, the escrow agents, the municipal clerks, all the waiting periods.
The code acts as the escrow.
That's wild. And finally, decentralization.
Right. The ledger isn't hosted on a single central server in the capital city that can be hacked, nor is it sitting in a local registry office that can catch fire or, get flooded. The record is distributed across multiple nodes.
But, and this is a crucial engineering detail, the sources clarify they aren't suggesting uploading highly sensitive massive files onto a public blockchain.
No, that would be terribly inefficient.
Right? They propose a hybrid approach. Because putting a 500-page high-resolution PDF map onto a blockchain network would be incredibly slow and wildly expensive. So how does this hybrid model actually work mechanically?
Think of a cryptographic hash like a digital meat grinder.
A meat grinder,
You
okay.
take your heavy 500-page digital property deed and you run it through the grinder. The algorithm spits out a unique 64-character string of letters and numbers. That's the hash.
So it's basically a digital fingerprint of that exact document.
Exactly. You take that tiny, lightweight 64-character hash and you anchor that onto the immutable blockchain.
Okay, and where does the big file go?
The actual heavy document, the maps, the stands, that stays off-chain in a traditional, secure government database.
Oh, I see.
Now, if a corrupt official goes into the traditional database and changes even a single comma in that 500-page document and you run it through the meat grinder again, the new hash will look completely different.
So when the bank compares the new hash to the hash permanently anchored on the blockchain, they don't match.
Exactly.
Alarm bells go off instantly. It's literally a tamper-evident seal for digital files.
That's a perfect way to put it. And the Democracy for Nepal analysis gives us a global tour of where this has been tested, detailing both the triumphs and the spectacular failures.
Let's look at the premier success story they mention, the Republic of Georgia.
Yeah, Georgia's the classic case study.
The sources say Georgia partnered with a tech company called Bitfury way back in 2016. And by 2018, they had secured over 1.5 million land titles using a private blockchain framework called Exonum.
Which they anchored to the Bitcoin blockchain for maximum security.
Right. And the analysis pinpoints exactly why Georgia succeeded. They possessed pre-existing, highly reliable digital data.
They weren't starting from chaos. They took a functional, clean digital register and just upgraded its security layer using blockchain.
Now contrast that with the failure mentioned in the text. Honduras.
Yeah.
Honduras tried to build a blockchain land registry early on and it completely fell apart. Why? Because the initial paper records were a disaster of overlapping claims and political infighting.
Which brings up the most glaring vulnerability of this entire concept. What computer scientists call the garbage in, garbage out dilemma.
Yes, I want to drill down on this. If blockchain is immutable, what happens if the data you put in is just wrong?
It's a huge problem.
Let's say a local mafia boss bribes an official to digitize a fraudulent claim. They steal a widow's farm, digitize the fake deed, and lock it onto the blockchain. Haven't we just permanently, cryptographically cemented a crime? Because if it's immutable, she can't get it changed back.
It is the absolute Achilles heel of using distributed ledgers for physical assets.
Yeah.
Blockchain secures data perfectly, but it does absolutely nothing to verify the truth of that data before it enters the system.
So how do you solve that?
The sources emphasize that robust upfront digitization and ground-level verification are mandatory. You have to resolve disputes before you record the hash on the chain.
Because if you engrave a lie in stone, it's just a very permanent, highly secure lie.
Precisely. And this is why the sources point to Indian initiatives like this SFMPC scheme. Rather than relying on old paper records, the government is flying high-resolution drones over thousands of villages.
to map the exact physical boundaries of every property.
Yes. They are using advanced technology to establish the empirical ground truth first. Then they use community validation to confirm ownership. Only after the truth is verified do they secure it on the ledger.
The text also mentions various state-level pilots in India, right? Like Telangana using blockchain to stop people from selling the same piece of land twice, which is called double registration.
And pilots in Haryana as well.
It even mentions Sweden using smart contracts to cut massive amounts of administrative overhead in their already formalized system, and nations like Ghana and Rwanda using digital tools to tackle customary informal tenure.
It's a massive global movement to digitize the physical world. But, and this is key, once a nation like India perfects this triad at home, once they have the identity, the payments, and the land secured, the strategy pivots entirely.
Right, they aren't just building this for themselves.
Right.
Which brings us to the next massive shift, exporting the stack.
The end game.
The authors argue that the true endgame is taking this domestic operating system and installing it across the global south.
The geopolitical strategy here is brilliant in its pragmatism. If you are an Indian tech giant or a government agency, you don't look to export this to the United States or Western Europe.
Why not, though? I mean, the money is there.
Because Western markets are totally saturated. They have deeply entrenched legacy financial systems, credit cards, SWIFT, private credit bureaus, and massive regulatory walls. Furthermore, the infrastructure challenges are completely different.
Oh, I see.
But if you look at the global south, nations across Africa, Latin America, and Southeast Asia, they face the exact same infrastructural hurdles India faced a decade ago.
High unbanked populations, spotty internet, heavy reliance on physical cash.
Exactly. An architecture designed to work flawlessly on low-bandwidth mobile networks for a rural farmer in India is perfectly suited for a rural farmer in Kenya or a vendor in Brazil.
That makes total sense.
And collectively, the global south represents a vastly larger addressable market and population base than the US, Europe, and China combined.
The revenue model the sources propose for this export strategy is really clever, too. They aren't acting like a traditional Western software company trying to sell a multi-billion-dollar locked-in enterprise license.
No, that wouldn't work.
The model suggests Indian tech firms provide the end-to-end open-source solutions, but the actual implementation and daily operations are handled by locally trained talent in the partner country.
Which guarantees data sovereignty for the partner nation. They aren't handing their citizens' data over to a foreign power.
So how do the tech providers actually make money?
Volume. The research suggests a microtransaction fee model, charging 1% or even less on the resulting digital ecosystems transactions.
Wow, just 1%.
It creates a perfectly aligned incentive structure. It becomes a sustainable, massive revenue stream. As the partner country's digital economy grows and flourishes, the microscopic revenue cut for the provider. Right. And the subtext here, which the sources definitely highlight, is that India is actively positioning itself as the low-cost, inclusive alternative to Western tech monopolies.
Because for decades, if a developing nation wanted to modernize its financial system, it basically had to rely on expensive American or European payment gateways and consulting firms.
Exactly. By providing a sovereign, nearly free alternative, India is actively building deep structural ties across the developing world.
You're essentially wiring the economies of the global south together using protocols designed in New Delhi.
Yep.
But laying the digital pipes is only half the battle. The critical question becomes, what is the actual substance flowing through those newly laid pipes?
Which brings us to the currency revolution.
Right. You've got the identity verified, you've got the interoperable payment rails running, you've got the land title secured. What is the actual money moving through the system? The sources make it clear that the future here belongs to central bank digital currencies, or CBDCs.
The data provided in the research regarding the global exploration of CBDCs is just staggering. As of mid-2026, 146 countries are actively exploring them.
146 countries.
That represents over 98% of global GDP, and 41 countries have moved into active pilot stages.
So basically the entire planet is looking into this.
Yes. But crucially, the text notes that the only fully launched live retail CBDCs are all located in the global south.
Really? Where?
The Sand Dollar in the Bahamas, JMADEX in Jamaica, and the Naira in Nigeria.
Why is the global south moving so much faster on this than the developed economies? Why hasn't the US or the UK launched one?
Because the pain points in the global south are much more acute. First, you have the issue of the unbanked. A traditional commercial bank account requires physical branch infrastructure, minimum balance requirements, high maintenance fees.
Which a lot of people just can't afford.
Right. A retail CBDC flips that. Combined with a digital ID, like we discussed, a citizen can simply download a digital wallet onto a basic smartphone. That wallet holds direct central bank money. It completely bypasses the need for a commercial bank.
The sources also heavily emphasized the crippling cost of remittances. If you are a worker in the UAE sending money home to your family in the Philippines or India, traditional money transfer operators like Western Union or correspondent banks take a massive percentage off the top.
And it can take days to clear.
A CBDC network could make cross-border remittances nearly instantaneous and virtually free, saving billions of dollars for working-class families globally.
Furthermore, many of these economies are heavily reliant on physical cash. Cash is anonymous, which makes it a nightmare for tax collection, and it's prone to physical theft and corruption.
But a digital currency leaves a verifiable, auditable trail.
Exactly. But the most powerful macroeconomic driver mentioned in the text is the pursuit of monetary sovereignty.
Meaning they want to escape the gravitational pull of the US dollar.
Exactly. Currently, if Brazil wants to trade with South Africa, the transaction is often priced in US dollars and routed through Western correspondent banks.
Which gives the US a lot of oversight and control.
The ability to conduct direct, bilateral regional trade using digital native currencies without having to route everything through New York is a massive strategic imperative for the global south.
The research also dives into the promise of programmable money, which is conceptually fascinating to me. Because a CBDC is literally just digital code, the central bank can attach conditions to it.
Yes, smart contracts again.
Right. Let's say the government issues agricultural relief funds to a farmer's wallet. They can program that money so it can only be spent at registered agricultural suppliers. And they can program an expiration date so it vanishes if not spent in 30 days.
It gives the state unprecedented precision in targeting welfare and stimulating specific sectors of the economy. It is the ultimate tool for monetary policy.
As we explore this, we have to confront the harsh reality of the early implementations. The authors of the Democracy for Nepal pieces are very clear-eyed about the massive risks and the current struggles these projects face.
Yeah, let's look at the actual track record. The Inara in Nigeria and the Jamdex in Jamaica are technically fully launched, but the research explicitly states they have suffered from very low uptake.
The citizens just aren't using them. Why is the adoption failing?
The sources point to a cascade of friction points. First is merchant adoption. A currency is only useful if you can spend it. If small street vendors and local shops refuse to accept the Inara because the app is clunky or they just don't understand it, consumers have no incentive to hold it.
Right. And second is the reality of the digital divide.
Exactly. You need a smartphone, you need internet access, you need electricity. If a central bank launches a highly advanced digital currency in a region that suffers from frequent rolling power blackouts, citizens will naturally revert to the safety of physical cash.
That makes total sense. Furthermore, there is massive competition from existing private systems. The text mentions mobile money like M-Pesa in Kenya, which is ubiquitous and deeply trusted.
If citizens already have a digital wallet provided by their telecom company that works perfectly well, what is the compelling incentive to switch to a clunky government app?
Which brings up a deeper psychological barrier. If the Nigerian government is aggressively promoting the Inara, and the public is collectively shrugging its shoulders, we have to ask, is this technology actually solving a problem the citizens feel they have? Or are central banks just building shiny, heavily surveilled infrastructure that people simply do not trust?
The text explicitly mentions surveillance fears as a major hurdle. If you move to a retail CBDC, the central bank theoretically has a log of every single transaction you make.
Which is terrifying.
For citizens in countries with a history of government overreach, that is a privacy nightmare. But beyond the individual fears, there are massive macroeconomic risks. The research highlights the danger of bank disintermediation.
I want to make sure I understand the mechanics of this risk. Disintermediation basically means cutting out the middleman, right?
Yes.
And in this case, the middleman is the commercial bank.
Correct. Think about how a commercial bank functions. You deposit your savings, and the bank uses those deposits as capital to lend out to other people for mortgages or business loans.
Right.
Now, imagine the central bank launches a completely secure, zero-fee digital wallet. If millions of citizens decide to move their savings out of commercial banks and into their direct CBDC wallets, the commercial banks suddenly lose their deposit base.
Meaning they have no capital left to lend.
Precisely. In a fragile developing economy, a highly successful CBDC could inadvertently trigger a massive credit crunch, literally starving small businesses of loans.
So that's a terrifying tightrope walk for these central banks.
Oh.
But the overarching vision in the sources doesn't end with single countries figuring out their own domestic currencies. The real paradigm shift, the thing that actually threatens global dollar dominance, is when these individual national digital currencies start talking to each other across borders.
Interoperability.
Yes. If every nation builds its own bespoke CBDC on a different technological standard, you haven't solved anything. You've just created a deeply fragmented digital world that's even harder to navigate than the current system.
The current global financial system relies on a slow, expensive web of correspondent banks and messaging networks like SWIFT. To move money from a small bank in India to a small bank in Peru requires multiple hops, currency conversions, and fees at every single step.
Which is incredibly inefficient.
If CBDCs are going to revolutionize trade, they must interoperate smoothly. The Democracy for Nepal sources outline 4 main architectural models for how central banks are attempting to connect their systems.
Let's walk through the mechanics of these 4 models, because this is the actual plumbing of the future global economy.
Okay, the first model is the most technologically ambitious. It's a single common platform, often called a multi-CBDC system. Instead of building their own isolated networks, multiple central banks agree to issue and transact their respective currencies on the exact same shared distributed ledger.
Meaning the friction of moving across borders drops to 0, because the money never actually leaves the platform. It just shifts ledgers internally.
Exactly. The second model is a hub-and-spoke or bilateral approach. This is more conservative. Individual nations keep their systems completely separate, but they build dedicated technological gateways or use a central clearing hub to translate transactions between them.
So it's akin to upgrading the existing SWIFT system with faster digital pipes.
Pretty much. The third approach mentioned is the compatible standards model.
Right. In this scenario, everyone builds whatever underlying ledger technology they want, but they all agree to use a common, standardized data language to communicate. The text heavily emphasizes the ISO 2022 messaging standard. Let me stop you there. What mechanically is ISO 2022? Is it just a wire format?
Think of it like a highly detailed, standardized shipping container for financial data.
Go, a shipping container.
In the old system, if Bank A sent a message to Bank B, Bank A might put the customer's name in field 1 and the address in field 2. But Bank B expects the address in field 1. It requires manual reconciliation.
Which takes time and money.
Right. ISO 2022 creates a universal data dictionary. Every single piece of information, the sender, the receiver, the purpose of the transaction, the regulatory compliance data, is tagged in the exact same format globally.
So even if the underlying blockchain ledgers are completely different, they can read each other's data instantly and without human intervention.
Exactly. A Rosetta Stone for global finance.
And the fourth model?
A hybrid approach. This involves linking existing domestic fast payment systems, like India's UPI connecting with Singapore's PayNow, across borders, sometimes incorporating CBDCs as a wholesale settlement layer in the background.
Okay, so those are the 4 blueprints. But what makes this part of the deep dive so utterly captivating is the geopolitical tech race happening right now to build these systems.
It really is a race.
The sources detail 2 massive competing projects that perfectly illustrate the global divide. Let's start with the one challenging the status quo, Project Enbridge.
The research describes Project Enbridge as one of the most advanced functional initiatives in the world. It was initially spearheaded by the Bank for International Settlements, or BI Innovation Hub, but look closely at the central bank partners driving it: China, Hong Kong, Thailand, the UAE, and more recently, Saudi Arabia.
That is a very specific, heavily BRICS-aligned, global south-oriented roster.
It is. And technologically, Enbridge chose the most ambitious route we discussed, the single common platform. They built a custom native distributed ledger, a bespoke blockchain consensus mechanism.
Wow.
Its primary focus is on wholesale cross-border payments for international trade. It allows these participating nations to settle massive multi-million-dollar trade volumes directly in their own sovereign digital currencies.
Which means they completely bypass the traditional Western correspondent banking system. They don't need US dollars, and they don't need SWIFT.
Precisely. And the text notes a critical milestone. Enbridge reached a minimum viable product stage, successfully processed millions of dollars in real value corporate transactions, and then in late 2024, the BIS essentially stepped back and handed operational control of the platform over to the participating central banks.
Wait, I want to explore the implications of that. If Enbridge allows nations to bypass traditional Western financial rails entirely, aren't they basically building a high-tech shadow financial system?
Yes.
If a nation faces U.S. sanctions, couldn't they theoretically just route all their international trade through Enbridge and completely evade the economic pressure? How does the G7 even respond to a parallel financial universe being turned on?
You have hit on the exact geopolitical anxiety driving Western policymakers. It is a parallel track that neuters the primary weapon of Western economic statecraft, which is sanctions, which is exactly why the G7 and Western financial institutions are scrambling to respond.
And the sources detail the primary Western counter-initiative, right? Project Agora. Tell me about Agora.
Project Agora was launched in 2024. Its participant list is a stark contrast to Enbridge. It involves multiple central banks from G7 and Western-aligned nations, operating alongside over 40 major private financial firms, including colossal commercial banks and SWIFT itself.
And how does Agora's technological approach differ from Enbridge?
Where Enbridge built a brand new sovereign ledger designed to operate outside the traditional system, Agora is focused on integration and preservation.
Preservation of the old system.
Exactly. The text notes that Agora is exploring tokenized assets and finding ways to seamlessly mix tokenized central bank money with existing commercial bank money on a unified ledger.
Okay, here is my analogy to crystallize this geopolitical battle. Think of global trade like the international railway system.
Okay.
For decades, absolutely everyone has been forced to use the existing Western-built tracks. You pay tolls to Western banks to use them. Now the Global South, via projects like Enbridge, is out there laying a brand new high-speed rail gauge specifically for their own trains. They're building a completely separate network.
Right.
Meanwhile, the G7, via Agora, realizes they are losing their monopoly. So they are trying to rapidly retrofit and upgrade the existing legacy tracks to handle faster digital trains and convince everyone to stay.
That is a highly accurate and illustrative way to frame the conflict. The research also mentions adjacent efforts like Project Dunbar and the SWIFT Sandbox, which are further attempts by the incumbent financial order to preserve the role of traditional correspondent banking while adopting the new messaging standards like ISO 2022.
So the stakes are winner take all. Whoever gets the majority of the world's countries to adopt their gauge, their specific set of tracks, essentially dictates the routing, the rules, and the surveillance of global trade for the next century.
Absolutely.
So where does India fit into this massive interoperability race? Are they picking a side?
The sources position India's strategy as remarkably flexible and strategic. India is aggressively expanding its own domestic e-Rupee pilots for both offline and cross-border use. The text specifically highlights bilateral links they are forging, such as the digital rupee dirham connection with the UAE.
It seems like India's goal isn't necessarily to build the single dominant global ledger like Enbridge, but to ensure that its own domestic operating system, the Aadhaar and UPI stack we spent the first half discussing, is so perfectly engineered that it can plug into whatever international system wins out.
Precisely. By building a highly adaptable digital triad at home, they retain ultimate sovereignty. If Enbridge becomes the dominant trade route for Asia, India's DPI can plug into it via API.
And if Agora wins?
If Agora successfully upgrades the Western system, India can interface with that just as easily. Or they can just continue exporting their own UPI rails directly to neighboring countries, creating their own micronetworks. They are positioning themselves as the indispensable technology provider and the essential bridge for the entire global South.
So as we bring this massive, sprawling deep dive to a close, let's synthesize exactly what the research from Democracy for Nepal has laid out. It is a breathtakingly ambitious roadmap for national transformation. It starts with the granular, highly successful domestic execution of Aadhaar for identity and UPI for payments.
Which they've already proven works at scale.
Right. It highlights the urgent, mathematically necessary push for a blockchain-secured land Aadhaar to turn dead capital into dynamic, leverageable wealth. And it culminates in the strategic export of this entire digital stack to the global South, providing the foundational infrastructure for a world of interoperable central bank digital currencies.
The underlying thesis of the blueprint is clear. We are witnessing a technologically driven shift toward a genuinely multipolar world economy, We're moving toward a reality where regional trade flows seamlessly through digital public goods, drastically reducing the historical dependence on a single dominant fiat currency or Western financial gateways. The architecture for a new world order is currently being coded.
It is an incredible, almost science fiction level vision of the near future. But as promised, I want to leave you, the listener, with a final, highly provocative thread to pull on. We've spent this entire deep dive discussing infrastructure built by governments, by central banks, and by state authorities. We've talked about state-run identity, state-run land registries, and sovereign digital currencies. But hidden in the margins of the sources is a brief, almost quiet warning about a completely different player: private stablecoins.
These are privately issued digital currencies, typically pegged one-to-one to the US dollar, run by private tech consortiums, borderless, and accessible to absolutely anyone on Earth with a basic internet connection.
Exactly. They compete directly and aggressively with the sovereign state systems we've been discussing. So here's the thought I want you to mull over as you go about your day. While sovereign nations spend years locked in complex bureaucratic geopolitical battles over Enbridge versus Agora, or while they struggle to perfectly digitize decades of messy, corrupt paper land records into a government-approved blockchain, will private, decentralized, dollar-backed stablecoins simply slip through the cracks?
A truly disruptive question. Does the sheer speed and frictionless nature of private digital adoption outpace the grand, slow design of sovereign public infrastructure?
Think about it. Will a farmer in Nigeria or a merchant in Argentina wait 5 years for their central bank to perfect a CBDC? Or will they just download a private stablecoin app today and start transacting in digital UF dollars, entirely bypassing their own government's bureaucracy? Could a private tech company quietly become the actual default financial infrastructure of the global south while the governments are busy arguing over ledger standards? It's a massive blind spot. Thank you so much for joining us on this deep dive. Keep questioning the code being written behind the scenes, and remember, whether it's a laptop or an entire national economy, whoever builds the operating system holds the keys to the future. Until next time.